Turkey has 75% inflation. Prices are doubling every 14 months. The lira lost 90% of its value against the dollar in the last 5 years, and the president responsible for destroying the currency refuses to change the policies that caused it. Right now, a loaf of bread in Istanbul costs what a week of groceries cost 3 years ago. Turkish families are watching their savings evaporate in real time. The middle class is disappearing, and Erdogan, who has been president for over 20 years, is telling the country that high interest rates cause inflation, which is the exact opposite of how economics works. The Central Bank of Turkey published data in December 2024 showing consumer prices up 75% year over year. That's down from the peak of 85% in early 2024, but it's still destroying purchasing power. And the reason it peaked at 85% in the first place is because Erdogan spent years forcing the central bank to keep interest rates low while inflation was accelerating. This crisis happened precisely when Erdogan overrode every principle of monetary economics to pursue his theory that low interest rates reduce inflation. The probability of sustaining a currency when the president systematically undermines the institution designed to protect it is zero. This is the pattern of every currency collapse in emerging market history. Venezuela, Zimbabwe, Argentina, Iran. In every single case, the government interfered with the central bank, forced interest rates too low, printed money to fund deficits, and the currency collapsed. Ibrahim Çiçekçi, former governor of the Central Bank of Turkey, stated after being removed from office in 2021, "The decision to cut rates while inflation is rising will destroy the lira. The market will not forgive this, and the consequences will be devastating for ordinary Turkish citizens." Even more damning, Erdogan fired 3 central bank governors in 18 months. Each one was removed for refusing to cut interest rates when Erdogan demanded it. The 4th governor finally complied and started cutting rates. Inflation exploded from 17% to 85% in 2 years. The assumption that a country with the 15th largest economy in the world could sustain unconventional monetary policy without consequences broke completely when the lira collapsed and Turkish citizens paid for it with their livelihoods. Here's what should terrify anyone watching this. Turkey is not a small country, 85 million people, NATO member, bridge between Europe and Asia, major regional power, and its currency is in freefall because one man refuses to accept basic economic reality. Think about that. Before we break down exactly how Erdogan's theory about interest rates destroyed the lira, why the central bank has been gutted of independence, what 75% inflation actually means for ordinary Turkish families, and whether Turkey can recover, or if this is permanent decline, if you want to understand how one leader's economic delusions can destroy a country's currency and middle class, hit that subscribe button and turn on notifications. Because what we're revealing will change how you see emerging market risk and why political interference with central banks is the fastest way to destroy a nation's wealth. Leave a comment. Can Turkey recover from this inflation crisis? Is Erdogan's theory about interest rates insane? Or is there something mainstream economists miss? And what happens to Turkey's economy if inflation doesn't come down? Let's start with the numbers because they reveal the scale of destruction. The Turkish lira in 2018 was trading at 5.5 per dollar. In 2019, 5.6. In 2020, 8.6. In 2021, 13.6. In 2022, 19.6. In 2023, 29. In 2024, 36. From 5.5 to 36 in 6 years. That's an 85% decline. If you had 1 million liras in 2018, it's worth 150,000 liras in purchasing power today. Turkey's GDP per capita in dollar terms fell from 12,500 in 2014 to 6,500 in 2024. Halved. A country that was on track to join the developed world is now retreating back into middle-income status. Consumer price inflation hit 85% at peak in February 2024. It's come down to 75% by December 2024 because the central bank finally started raising rates after the 2023 election. But 75% is still devastating. Producer price inflation, which measures costs for businesses, was over 100% for most of 2024. Businesses are paying double for inputs. Some can pass costs to consumers. Others absorb losses. Many are going bankrupt. The unemployment rate is officially 10%, but that's understated. If you include underemployment and people who stopped looking, real unemployment is closer to 25%. Young people are emigrating in massive numbers. These numbers tell the story of an economy in systematic destruction, not recession. Destruction. The currency, savings, middle class, all being wiped out simultaneously. Now let's talk about Erdogan's theory, because it's central to understanding why this happened. Standard monetary economics teaches that when inflation rises, the central bank raises interest rates. Higher rates make borrowing expensive. Consumers and businesses spend less. Demand falls. Prices stop rising. This is textbook central banking. Every country in the world follows this principle. Erdogan believes the opposite. He publicly stated multiple times that high interest rates cause inflation. His theory is that when borrowing is expensive, businesses pass the cost to consumers through higher prices. Therefore, low interest rates reduce inflation because businesses can borrow cheaply and don't need to raise prices. This is not mainstream economics. No Nobel laureate supports this theory. No central bank in the world implements this theory. It contradicts decades of empirical evidence. But Erdogan is convinced. He's stated this theory in press conferences, in parliament, in interviews. He's fired central bank governors who disagree. He's appointed governors who implement his theory. Why does he believe this? Partly ideology. Erdogan is influenced by Islamic economics, which views interest as morally wrong. Lending at interest is prohibited in Islam. So from a religious perspective, low rates are morally correct. Partly ego. He's been president for over 20 years. He's used to being right. His political survival depends on appearing decisive and correct. Admitting that his economic theory is wrong would be humiliating. Partly short-term political calculation. Low interest rates stimulate economic growth in the short term. Construction booms, consumer spending rises. Before elections, this creates an appearance of prosperity. The inflation consequences come later. Whatever the reason, Erdogan has systematically dismantled Turkey's monetary framework by forcing the central bank to implement his theory, and the results speak for themselves. Now let's talk about the central bank because its independence has been destroyed. Central bank independence means the central bank can make monetary policy decisions without political interference. This was established globally after the disasters of the 1970s and 1980s when governments forced central banks to print money and inflation destroyed economies. Turkey's central bank was nominally independent, but in practice, the president had enormous influence over appointments. Governors who disagreed with Erdogan were fired. In March 2021, Erdogan fired Naci Ağbal, who had been raising interest rates to fight inflation. Ağbal was in the job for 4 months. He raised rates. Inflation was starting to come down. Markets were stabilizing. Then Erdogan removed him, replaced with a governor who immediately cut rates. The lira crashed 14% in one day. Markets understood what the change meant. Then that governor was also fired, replaced with another. Over the next 2 years, Turkey went through multiple governors. Each one was expected to cut rates regardless of inflation data. The ones who hesitated were removed. By 2023 election, the central bank had cut rates to 8.5%, while inflation was above 50%. Real interest rates were negative 40%. That means borrowing was essentially free after adjusting for inflation. Money flooded into Turkey. Currency collapsed. After winning the 2023 election, Erdogan surprised markets by appointing Hafize Erkan as central bank governor. Erkan started raising rates, from 8.5% to 40% by early 2024, then to 50%. Markets stabilized somewhat, but then Erkan was fired too. In February 2024, replaced with another governor. The market interpreted this as Erdogan wanting rates cut again. Lira weakened. The pattern is clear. Any governor who doesn't follow Erdogan's wishes is removed. The central bank is not independent. It's a tool of political will. And when the political will contradicts economic reality, the currency pays the price. Now let's talk about what 75% inflation actually means for ordinary Turkish people, because the numbers are abstract until you see the impact on daily life. A family that spent 2,000 liras on groceries per month in 2022 now spends 3,500. Same food, same quantities, just more expensive. Rent in Istanbul increased 120% in 2 years. A one-bedroom apartment that cost 15,000 liras per month in 2022 is now 33,000, but wages didn't double. Average wage increased 40%, so real purchasing power collapsed. Minimum wage in Turkey is 23,700 liras per month. After taxes, take-home is about 19,000. Rent alone is 33,000 in Istanbul. Minimum wage workers can't afford to live in the capital. Savings are being destroyed. If you had 100,000 liras in the bank in 2022, it buys what 35,000 liras bought then. You lost 65% of purchasing power without spending a single lira. The response of Turkish consumers is predictable. They're converting liras to dollars and euros as fast as possible. Foreign currency deposits at Turkish banks have surged. The central bank estimates Turkish citizens hold over $100 billion in foreign currency accounts, plus cash dollars stored at home. This dollarization is rational behavior. If your currency is losing value, why hold it? Convert to something that's stable. But dollarization undermines the lira further. Less demand for liras, more demand for dollars. Exchange rate weakens. Inflation rises. More people convert to dollars. Feedback loop. Tourism used to be Turkey's economic lifeline. Foreigners came because Turkey was cheap. But inflation is eroding that advantage. Turkey is getting expensive relative to neighbors. Tourism revenue growth is slowing. Foreign direct investment collapsed. Why invest in a country where your returns are denominated in a currency losing 50% per year? FDI fell 60% from 2022 to 2024. Companies are leaving or not expanding. Brain drain is accelerating. Educated Turks are emigrating. Germany, UK, US, Canada. Turkey is losing its most productive citizens to countries with stable currencies and opportunities. The social consequences are severe. Youth unemployment, loss of middle class, political polarization. Erdogan's base is rural and religious. Urban educated voters have turned against him. The country is splitting economically and culturally. Now let's talk about whether Erdogan's current policies can actually fix the crisis, because the central bank has been raising rates since mid-2023. After the 2023 election, rates went from 8.5% to 50% by December 2024. That's a dramatic tightening, and inflation has come down from 85% to 75%. So is it working? Partially. The rate of inflation is moderating, but the absolute level is still devastating. 75% means prices are still rising 3/4 of what they were a year ago, only at that level. Real interest rates are now negative 25%. Interest rates are 50%, but inflation is 75%. So after adjusting for inflation, you're still losing money in Turkish banks, only less than before. For real interest rates to be positive, and that's what's needed to actually fight inflation, rates need to exceed inflation. That means rates above 75%, possibly above 100% temporarily. But Erdogan doesn't want rates that high. He's already pressuring the central bank to start cutting. He fired the governor who wanted to keep rates elevated. The new governor is expected to be more accommodating. If rates are cut prematurely, inflation will re-accelerate, the lira will weaken again, and Turkey will be back to where it was in 2023. The fundamental problem is the political will to sustain painful monetary policy doesn't exist. Erdogan won't accept the short-term economic pain necessary to restore stability. Turkey needs sustained period of high real interest rates, probably 2 to 3 years of rates above inflation. This causes recession, unemployment rises, growth stalls. It's painful. But the alternative is continued inflation that destroys the currency and the middle class, which is more painful long-term. Erdogan keeps choosing short-term comfort over long-term stability, and Turkish citizens keep paying the price. Now let's talk about the parallels with other countries, because Turkey is not unique. Venezuela is the extreme case. Hugo Chavez and Nicolas Maduro systematically destroyed the Venezuelan economy with price controls, currency manipulation, and central bank interference. Result was hyperinflation exceeding 1,000,000%. Currency became worthless. Economy contracted 65%. Turkey isn't at Venezuela's level, but the mechanism is identical. Political leader overrides economic institutions. Currency collapses. Savings destroyed. Argentina has gone through multiple currency crises over decades, each one caused by fiscal deficits financed by money printing and political interference with monetary policy. Each time, the pattern is the same. Inflation spikes. Currency collapses. IMF bailout. Temporary stabilization. Then the cycle repeats. Turkey is following Argentina's playbook. The difference is, Turkey hasn't fully defaulted yet, and Erdogan hasn't gone to the IMF, which would require admitting failure. Iran's currency collapse follows the same pattern. Government controls monetary policy for political purposes. Sanctions add additional pressure. But the fundamental mechanism is political interference with the currency. Zimbabwe in the 2000s is the cautionary tale of what happens when you take it to the extreme. Government printed money to fund spending. Inflation hit 400 billion%. Currency became worthless. Economy destroyed for a generation. In every single case, the common factor is political interference with the central bank. When politicians control the money supply, they always choose short-term benefit over long-term stability, because elections are every 4 to 6 years. But the consequences of bad monetary policy take years to materialize. Erdogan has been in power for over 20 years, long enough to see the consequences of his policies, and he still won't change. Now let's talk about what this means for regional stability and global markets, because Turkey is too important to ignore. Turkey is NATO's second-largest military, bridge between Europe and Asia, controls the Turkish Strait, which connects the Black Sea to the Mediterranean. About 3% of global oil trade passes through. If Turkey's economy collapses severely, political instability follows. Erdogan's grip on power depends partly on economic performance. If inflation continues destroying the middle class, support for regime could weaken. Political instability in Turkey threatens regional security. Syria, Iraq, Kurdish regions, all affected by Turkey's political dynamics. NATO alliance could be stressed if Turkey turns toward Russia for economic support. Europe is exposed through migration. Turkey hosts 4 million Syrian refugees. If Turkey's economy deteriorates further, pressure on migration could increase. Europe has already shown it struggles to handle migration crises. Turkish banks have significant international exposure. Turkish companies have issued billions in dollar-denominated debt. If these companies can't service dollar debt because Lira collapsed, defaults follow. This affects international bond markets. Emerging market contagion is a real risk. If investors lose confidence in Turkey, they often reduce exposure to other emerging markets simultaneously. Brazilian real, South African rand, Indian rupee, all can weaken on Turkey-related fears. The Turkish lira is now one of the worst-performing currencies in the world. Global investors are avoiding it. Capital flows have shifted away from Turkey to other emerging markets with better fundamentals. For global commodity markets, Turkey is a significant buyer of energy and agricultural imports. If purchasing power collapses further, import demand falls. This affects prices for oil, wheat, and other commodities that Turkey buys. Now let's talk about whether recovery is possible, because history shows some countries have come back from similar crises. Russia in the late 1990s had currency crisis after ruble collapse, but they stabilized through fiscal discipline, high interest rates, and commodity wealth from oil. Economy recovered within 2 years. South Korea recovered from the 1997 Asian financial crisis, implemented aggressive reforms, opened markets, attracted foreign investment, became one of world's strongest economies within a decade. Argentina stabilized multiple times, each time for a few years before the next crisis. The pattern repeats. For Turkey to recover, several things need to happen. First, the central bank needs real independence. Erdogan needs to commit to keeping rates high regardless of political cost. This has never happened under his leadership. Second, fiscal discipline. Government spending needs to be contained. Deficits need to shrink. This is politically difficult because Erdogan funds patronage networks through government spending. Third, structural reforms. Labor market flexibility, reducing bureaucracy, improving rule of law, making Turkey attractive to foreign investment. These take years and political will that doesn't exist. Fourth, Erdogan needs to step back from economic policy. Let technocrats manage, accept short-term pain for long-term stability. This contradicts his personality and political style. The probability of all four happening simultaneously is very low. Erdogan has shown over 20 years that he prioritizes political control over economic rationality. So recovery is possible in theory, but practically unlikely while Erdogan remains in power and continues his approach to monetary policy. The most likely outcome is continued slow destruction. Inflation stays elevated, maybe coming down to 40 or 50% over next 2 years, but real purchasing power continues declining. Middle class continues shrinking. Brain drain continues. And Turkey remains a cautionary tale of what happens when politics override economics. Now let's address the counter-argument, because some people defend Erdogan's approach. They argue that Turkey's inflation is caused by external factors, sanctions, oil prices, supply chain disruptions, war in Ukraine. These are real pressures, but they affect every country. Why is Turkey's inflation 10 times worse than neighbors? Turkey's neighbors had similar external shocks, but didn't see the same currency collapse because their central banks maintained independence and raised rates appropriately. Some argue that high interest rates hurt small businesses and entrepreneurs. This is true. High rates make borrowing expensive, but the alternative, 75% inflation, destroys their savings and purchasing power even faster. Some argue that Turkey's inflation will come down naturally as global prices stabilize. Partially true. But the lira has already lost 90% of its value. Even if inflation moderates, the damage to savings and purchasing power is permanent. The fundamental reality is there's no free lunch in economics. You can't have low interest rates and stable currency when inflation is high. That's not opinion, it's mathematical relationship. The currency will adjust, and adjustment means destruction of savings. Erdogan promised Turkish citizens they could have both, low rates and stable currency. It was a lie, and the currency proved it. If this breakdown of how Erdogan's economic theory destroyed the lira, why central bank independence matters, what 75% inflation means for real people, and why Turkey's crisis is unlikely to be fixed, changed how you see emerging market currencies and political risk, hit that like button and subscribe. We're tracking every central bank decision, every currency move, every sign of whether Turkey stabilizes or continues declining. Leave a comment. Can Turkey recover from this inflation? Is Erdogan's theory about interest rates completely wrong, or is there something to it? What happens to Turkey's economy if inflation doesn't come down? Share this with anyone interested in emerging markets, currency risk, or anyone who thinks inflation is just rising prices and nothing more. After this, they'll understand why 75% inflation is economic warfare against your own citizens, and why one leader's refusal to accept economic reality can destroy a nation's middle class.